Welcome to our revision lecture on IAS 21. The purpose of this revision lecture is to identify the principles that we need to apply when we need to translate a foreign operation into our group for consolidation purposes. Now, when you look at the revision screen, we will start off with our translation rates that we need to know in terms of IAS 21. How to treat goodwill being recognized, how to treat revaluations, monetary items, as well as the disposal or partial disposal of a foreign operation. Now let's first have a look at the translation rates. Now unfortunately you will have to study these rates and know them. I'm briefly going to read through them with you. Now when we look at our items, our assets and liabilities as per our statement of financial position, you need to use the closing rate. Now, what does this mean? If in your trial balance you have a foreign currency of an asset being 100 and our closing rate is 10 Rand, if you translate this to a presentation currency being Rand, you need to use the 100 times 10, and this will be 1,000 Rand. Now, income and expenses relating to our profit and loss statement, you need to use an average rate. At acquisition equity, similar principles that you need to apply as per your IFRS 3 rules. You need to use your acquisition date rate. For any post-acquisition equity to the beginning of the period, you need to use the rate used in prior conversion trial balances. Then an important one, our goodwill. Goodwill you need to treat as an asset of the foreign operation. Now we will discuss this in detail just now. And at the end of each reporting period, you need to translate your foreign currency of your goodwill to using a closing rate to your presentation currency. And this shall result in FCTR relating to our goodwill asset. Then our fair value adjustments. Now fair value adjustments or our revaluations. You need to treat this as an asset or liability of the foreign operation, and you need to remember that you will have to translate this using the closing rate at the end of each period to your presentation currency. Intra-group items such as dividends being paid, you need to use the transaction date rate, and if there is any transfers to reserves for a current period by the foreign operation, you need to apply your closing rate. Now, before we look at our goodwill, why will we recognize an FCTR account? I'm going to explain this by means of an extremely basic example. When you start with your group consolidation, you will receive trial balances of your parent as well as all of your subsidiaries. Now, from an auditing point of view, what is the first test that you need to do on your trial balance? You need to identify if your trial balance add to 0. Your trial balance should balance. Now, we receive a trial balance of a foreign operation, and this will be in the foreign currency. Therefore, you will have your assets, your liabilities, and this will result in your equity. And your trial balance will balance in the foreign currency. But now, due to the rules that we have identified relating to our translation rates of IAS 21, we need to translate all of these items to a presentation currency of our parent, being Rand in this example. And at the end, when you test your trial balance, you will identify that this trial balance will not balance. Why not? Because we have different rules. We had to translate our statement of financial position line items using a closing rate. We had to translate our profit or loss for the year using an average rate. Remember, you need to translate this to the presentation currency to be able to incorporate this trial balance into our group. And therefore, we will not have a trial balance that balance. And this amount will be recognized in our group to our FCTR account. Remember that this is a very basic example. Now, IAS 21 indicates to us that this FCTR account that we recognize should be divided into our parents' portion as well as our NCI's portion. Now I want you to only focus on our Goodwill section. Now, for you to be able to follow my writing, I am going to use a purple color when I explain principles. Now, IAS 21 indicates to us that when there is goodwill recognized at acquisition, we need to treat this as an asset of our foreign operation. Now, let's just quickly take this one step back. You will remember we have identified that an FCTR account will be recognized, and we need to divide this into our parents' portion as well as our NCI's portion in our analysis of owner's equity. Now, at acquisition date, we will recognize goodwill. Remember, at acquisition date, goodwill will be recognized in terms of our IFRS 3 principles. But what is important to identify, that goodwill you will first calculate in the presentation currency, and we use rand, and then you will translate this back to the foreign currency. Now for our since period. Our since period, you have to revalue your goodwill again based on our closing rate. Please look at your translation table. If you look at goodwill, we need to revalue this based on our closing rate. We have our foreign currency determined in our at acquisition period, and you now need to translate this using your closing rate to a rand value. And when you look at this, there will be a difference in the rand values. And this difference, we need to identify that this will be our FCTR. Now this will be the FCTR relating to our goodwill. Now there is a catch. When you think about your NCI accounting policies, our NCI can either be accounted for based on our proportionate share, and our NCI will not share in our goodwill, or based on our fair value, and then our NCI will share in our goodwill. Now, when the NCI shares in our goodwill, remember, we will now recognize an FCTR amount relating to the translation of our goodwill. You need to remember that that FCTR amount should be divided and allocated to your parent as well as to your NCI. Now let's have a look at the implication of this on an analysis of owner's equity template. Remember that I do prefer using an analysis of owner's equity when I consolidate subsidiaries. Now, when you use an analysis of owner's equity and you have a foreign operation, you need to include a total for your foreign currency column. You need to include a column for your rate and include your presentation currency. Remember, I use rand. And include your parent's portion of your presentation currency as well as your NCI's portion. Now, your analysis of owner's equity, as always, will have your at acquisition period, a since acquisition period, and a current year period, which will be your profit or loss for the current year. Now, when you look at your steps, remember step 1, you need to translate the foreign currency at acquisition owner's equity to your presentation currency using your at acquisition date rate. Therefore, you will use all of your equity at acquisition, translate this to your presentation currency, and this will be step 1. Then you need to calculate your goodwill using your presentation currency. Remember, this will be the difference between your consideration paid and your net assets. Will either be goodwill or a gain on bargain purchase. Your step 2, you need to calculate your goodwill first in your presentation currency, and then you need to translate this back to your foreign currency. Your step 3, you need to translate your retained earnings or your profit for the current period. Let's look at our profit. Step 3, you need to translate your foreign currency of your profit based on your average rate into your presentation currency. Step 3. Step 4. You need to remeasure your foreign currency goodwill. Important, guys. Look at this. Remember, we have calculated our goodwill in a foreign currency at acquisition date. We now need to remeasure this and translate this using our closing rate. Okay? This will then provide us with a rand value. And you need to compare the rand value that we have recognized in our at acquisition date with the rand value of our since period. And this difference will be your FCTR relating to your goodwill. Now, important to identify, guys. The FCTR relating to the goodwill, you will include in your analysis of owner's equity. You're not going to include this rand value total. I'm only using this to explain to you the principle. Okay. Now, step 5. Step 5, you need to translate your year-end total foreign currency of your owner's equity. Therefore, let's include this being my step 5. You have calculated your total foreign currency, and we now need to translate this to our presentation currency using our closing rate at year end. Now, important to identify, guys, that the difference in your totals, meaning that when you add your total rand presentation column before you have transferred your foreign currency, before step 5, guys, if you had determined your total of your presentation currency, let's indicate here where my blue line is included, guys. If you've calculated your total rand value of your presentation currency, and in step 5 you translate the total of your foreign currency. Remember now my step 5, total foreign currency. This difference will be your FCTR. Now, what is important to identify, and I've included this in red at the bottom, is that this FCTR will have your goodwill portion as well as your other portion. And the other portion relates to your normal translation of your IAS 21 principles. Now, let's refer back to our revision page. Now I want you to focus only on the revaluations block. I'm going to make use of this pink color when I write anything for you to be able to follow. Now, there's two things that you need to be able to identify. We can have a revaluation, or we call this fair value adjustment, either at acquisition date, or we can have a revaluation fair value adjustment after acquisition date. But how do you treat this, guys? If there is a revaluation at acquisition, you will treat this as an asset or liability of our foreign operation. Number two, if we have a revaluation after our acquisition date, this method of translation will have an impact on the rand amount of our revaluation surplus. Okay, do you see the difference, guys? Option 1 will have an impact on our FCTR. Option 2 on our rand amount of our revaluation surplus. Now, let's identify the implication of this on our analysis of owner's equity. When you look at the analysis of owner's equity, remember we have scenario number 1 where we have our revaluation at acquisition date, and scenario number 2 when we have our revaluation after acquisition date. Now, when you look at scenario number 1, revaluation at acquisition date, you will identify that this revaluation, guys, will be included in our at acquisition date, and we will use the rate of our at acquisition date to translate this revaluation. You need to identify this as a separate asset or liability of our foreign operation. Now, when you look at our since period, we will have our revaluation surplus, our foreign currency. You need to use the revaluation date rate to translate this to your rand value. And this will then have an effect on your revaluation surplus in your OCI, your normal journal entry as per your consolidation process. I want you now to please refer back to your revision page. Now I want you to focus only on the monetary items section on our revision page, and I'm going to make use of this light blue color when I explain and add additional comments. Now, when we look at monetary items, how do we account for the foreign currency forex of a monetary item in our separate financials versus our consolidated financial statements? I'm going to read through the principles briefly with you, and then we're going to look at a very basic example. Now, when we look at our separate financial statements of our parent, important guys, the investor, the forex due to our monetary item. Now remember, why will there be a foreign exchange gains or loss? Because our IAS 21 principles indicate to us that at the end of our reporting period, we need to remeasure all of our foreign line items in our trial balance using a closing rate to our presentation currencies, okay? And this will be part of our net investment in the foreign operation. Therefore, you will either recognize that forex as part of our profit or loss, or OCI. Now, when you look at your consolidated financials, and this is the rule that you need to study, the foreign currency that we have recognized in our separate records, very important guys, the foreign currency that we've recognized in our separate records should now be reclassified to the FCTR account through our OCI. And this is the main principle that you need to know. Now, let's have a look at our basic example. In this example, we have a parent that has an investment in a foreign operation, and this is a subsidiary in terms of IFRS 10 that should be consolidated. Now, a loan is made to our foreign operation in a foreign currency of the foreign operation on 1 June 2016 to the value of $200,000, repayable in the foreign currency. Now they provide us with our rates on 1 June 2016, $1 equals 10 Rand, and end of the year, $1, 11 Rand. Now, when we look at our journal entry in the separate financials of our parent on 1 June, we will debit our loan receivable, and this will be the 200,000 times 10 Rand. And our rules in terms of IAS 21 at the end of our reporting period, we need to translate all of our foreign currencies using our closing rate, and this is 11 Rand. Therefore, the value of our loan at the end of our reporting period should be an amount of 2.2 million. And our loan receivable has to increase, therefore debit loan receivable with 200,000. Now important, when you look at the principles of IAS 21, where we indicate that this is part of our net investment in our separate financials, what does this actually mean? If you look at our journals, journal number 1, we've debited our loan receivable with 2 million. Journal number 2, debit loan receivable 200,000. Therefore, the net investment relating to this loan will be the 2.2 million. And we will be able to identify that this will be part of our investment in our subsidiary, or not part of it, guys, because we're not going to net this off. But when you look at your financial statements, you will be able to identify that there will be a line item investment in subsidiary, and we will have our loan receivable from our subsidiary. Therefore, this will result in a net investment amount. Now, for group purposes, there will be an additional pro forma journal entry. We need to transfer the foreign exchange gain of 200,000 in our group, guys. Remember, we need to take this out, and we need to transfer this to our FCTR account. And this is an additional pro forma journal entry that you need to remember when the requirement indicates that you need to include your pro forma journals. And you need to remember to eliminate your intra-group loan in our group. Now I want you to focus only on the disposal or partial disposal on our revision page. Again, I'm going to briefly read through this with you, and then we're going to have a look at the implication thereof. I'm going to make use of a dark green color when I add additional comments. Now, remember disposal, partial disposal. You will have to follow exactly the same rules as per our change in ownership lectures. You need to look at your parent first. If there's any cumulative FCTR amounts, you will have to reclassify this from equity to your profit and loss. Now, what is your journal entry when you reclassify? You will have to debit your FCTR account and credit your profit or loss reclassification amount. When gain or loss on disposal is recognized, you need to recognize your gain or loss as well. When you look at your NCI, your FCTR derecognized will not be reclassified to your profit or loss. Now, let's have a look at the implication on our statement of changes in equity. Remember, when we recognize an FCTR account, that FCTR account shall be included in your statement of changes in equity, and you need to add an additional column. Now, our FCTR account will have an opening balance and there might be a current year amount recognized, and this will result in our closing balance. Now, when there is a disposal, remember, this FCTR column will only relate to our parent. When there's a disposal, you need to take out that amount and you need to transfer that to your profit or loss via your journal. Debit your FCTR and credit your profit or loss reclassification adjustment. And we've indicated that the amount included in our NCI will not be reclassified to our profit or loss. You need to follow your normal change in ownership principles as per our change in ownership lectures. Now please refer back to your revision page. We have now completed our revision page, but before we conclude, please remember to refer back to IFRS 12 and ensure that you know how to disclose a foreign operation in your financial statements. Thanks for watching.